Hello, fellow investors. Welcome to another episode of Ritter on Real Estate. Today, we're going to take a deep dive into what it really takes to launch and scale a real estate private equity firm, from building investor trust, structuring deals, and creating opportunities that can actually attract institutional capital. Joining me today is someone who's done it all, August Biniaz. He's the co-founder and chief investment officer at CPI Capital. He's closed over $225 million in multifamily and build-to-rent deals, and he's the host of the Real Estate Investing Demystified podcast. So August, welcome to the show. It's great to have you here.
Kent, I've been looking forward to this. Thanks for having me.
Yeah, absolutely, man. This will be a fun conversation. But let's get into it. Start from the beginning. What I'm really interested in is take us back to that moment where you decided to start CPI Capital. What gave you the confidence to say, I'm going to open a private equity firm. I'm going to start it from the ground up.
Yeah, no, absolutely. I mean, the confidence, if you try to build up all the confidence in the world, it still doesn't really, it can make up for what is needed to build a real estate private equity firm, because you're talking about institutions. You're talking about large firms out there. Blackstone, on one of their hiring rounds, they had over 90,000 applicants and only less than 0.25% were accepted. So, you're competing with the Goliaths of the business, really, right? One of the greatest minds in the world. That's where they want to go and work. So they have some of the best talent in the world to analyze deals and markets and execute the business plan. So, like I said, confidence is one side of it, but there's an aspect of insanity that you need to have to even think you can have a success in this business. But there is a middle market within real estate, private equity, that's possible by putting together funds and real estate syndications. In our case, we felt that we had somewhat of a monopoly. Initially, company was formed in Canada, which our mandate and goal was to allow Canadian investors to have exposure to U.S. multifamily syndicated deals, which was hard for investors to have that access. They could have some access to U.S. real estate through public REITs, but the yield on that just wasn't there, and it wasn't the same business model as syndication. So that really gave us that inertia starting out. But yeah, it's more of a realizing where you fit within this business, and yeah, the confidence is part of it as well, I guess.
Yeah, outside of the confidence and kind of understanding of where you fit in the market, there's a lot of people that never make that leap to get started, right? You're researching, maybe you're listening to podcasts. What do you think it is that really separates you, or maybe what it is about you or your mindset or whatever you've developed that allowed you to really take that leap, and build this company?
Yeah, and frankly, talking about this, I've been dedicated the last 6 years of my life to real estate investments, real estate private equity in particular. I've been in real estate for close to 20 years, maybe a 20-year mark now, and I've really done everything within the real estate space, but I'm still learning lots. Maybe the answer there is some people shouldn't get involved in this business. A lot of times there is a survivor fallacy where people see a doctor or a chiropractor or an engineer gets into space and do tremendously well. We've all, I'm sure some of you have read Wall Street Journal articles about somebody who had a everyday W-2 type of job, as is known in Canada, T4 type of work, and they started a real estate investment firm, and then now they have billions and billions of dollars of assets under management. But that's not the case always. You don't see the other 99% that failed, right? Even if you look at real estate brokerage, right, only the top 1% of real estate agents actually earn a serious living and make a dent. So it's even harder. The percentage, in my opinion, I don't have any data to back this, but the percentage, in my opinion, is even less for people who have success in real estate private equity. And the reason is because there's so many moving components and there's so many moving parts within the business, and most of the profits are made on the back end, on the upside. So yes, there are fees associated in the business where fund managers, general partners can charge the partnership early on, but all the real money is made on the back end. So the question is, how are you going to fund a company to be able to get to that stage? Now, in an up market, when people are buying deals and turning around and really, in a way, almost wholesaling it, not really wholesaling it. They're still holding it and having some business plan, but not even executing the business plan. They're just riding the wave from 2011 all the way to 2019. It was that wave where many rode that wave, and they're putting bridge debt on these deals and financially engineering the LP economics, and they're doing really well. A lot of people had great success, but that's not really the way the business works. The real estate has cycles, and I'm sure we're going to get into that later on. But yeah, some people shouldn't get into the business. And if you are getting into it, you need to have the right partners. You need to have the right mindset. You need to have the right resilient personality. So many aspects that goes into the business.
Yeah, well, that's a great segue, because I've heard you say before that real estate, private equity, it's a team sport. So I'm curious, as obviously you didn't grow the whole company on your own. I'm curious, what were those key hires or key partnerships that have come along in your career that have accelerated your growth?
Yeah, I mean, looking at this business, any real estate deal, even in a case of fix and flip, this is a factor. But more primarily looking at real estate private equity and utilizing the syndication model, the fund model, the REIT model. Doesn't matter what vehicle you're using to structure your deals. If you're out there raising money from the members of the public and buying real estate deals, there's really three main components of that business. One is acquisitions, I call it acquisition, which is going out there and finding the deals, right? Is analysis, market research, connection with brokers, is having deal flow, knowing what markets you want to be in. So that falls under acquisitions umbrella. So you need a team member who specializes in acquisitions and has a great understanding of deal underwriting and Excel models and underwriting models and so on. The other aspect of the business component of the business is executing the business plan. Is basically great. Now you raised the money you needed. You found the deal. You put it under contract. You purchased it. But now it's time to execute the business. So I call that under that umbrella as asset management, where you execute the business plan. And to be able to achieve both of these, buying a deal and executing the business plan, you need to have funding. So both debt and equity. Debt comes from the bank in most cases, or some financial institution, and equity comes from investors, be it one investor, one high net worth investor, one institutional investor, or a group of retail investors, limited partner investors. So those are three main components of the business. Now, you could break it down even more. You could bring on marketing as well, but marketing really, in my opinion, falls under the investor relations umbrella. But to be able to build a business, you need to have those three components, and it's near impossible for one person to manage all of those aspects. So if you can bring on a couple other partners who oversee those departments, that allows the business to be much more, you expedite that timeline of being able to have the growth you need and the expansion you need and the success you need. So acquisitions, asset management, and investor relations. For me, early on, it was obvious that I wasn't going to be able to achieve all of that myself. I brought on a couple of great partners early on with CPI. My partner, Ava Benesaki, who looks after our investor relations department and marketing and other aspects. My partner, Paul Hopkins, who looks after acquisitions. And myself, more on the operations and asset management as well.
I gotcha. So you've described these kind of three verticals, and you have a partner essentially in CPI that sits on top of each of those verticals and runs that part of the business.
Exactly.
Gotcha. Well, fantastic. Let's zoom in now on, one of your specialties. You've talked about raising millions of dollars from high net worth investors. I'm curious, what's your framework for building credibility and for getting investors comfortable and giving them the clarity to commit to, a deal with you?
Yeah, I come from a real estate background, been in real estate most of my professional career, and I used to build homes for over a decade. For 10 years, I used to build single family homes. I used to build both custom and spec home. Custom home is when somebody hires you as a builder to build them a home to their specifications and their needs. Spec home is when you build a home and you put it on the market to sell it for profit. So one, you're a service provider. On the other, you're an investor. So I was doing both of that. And being in that business for 10 years, I realized that equity is the most important part of the business. And I really felt my mindset was I'm limited to the size of deals that I can do, that I have access to the equity that's needed. Maybe some close friends. My mother was my first investor who came on and helped me out to buy some of the larger homes that I was building. So yeah, but I hadn't really got into the syndication model. Never heard the term syndication until 7 years ago, where I went down this line of research to find out what it was, and it really taught me a lot to understand that there is a mechanism to be able to raise capital. And this was initially in Canada, so there is securities commissions in Canada that oversees all the compliance related to raising capital and rules and regulations. But coming into this business, when I co-founded CPI, I knew that the equity was a very important part of the business. And to be able to raise capital, people need to understand who you are, who the company is, and their company needs to have some level of track record. So initially, we dedicated a lot of time and resources to building a brand around not CPI itself, but also the executive team of CPI. So that meant to launching our own podcast, Real Estate Investing Demystified, as you mentioned earlier. And we hope to have you on our show very soon as well. But building a brand around ourselves, we got very active on LinkedIn. Is a professional platform. So both me and my partner are both LinkedIn top voices. Myself and Ava are. And so we create a lot of content on LinkedIn. We also utilize LinkedIn outreach to be able to connect with potential investors and potential partners as well. And then social media, and started going to a lot of conferences, renting booths at some conferences. So I can go over many different, going on podcasts like such as yours and so on, hosting webinars. So getting the name out there, getting the business model out there. So that was really the initial process, is at least create a brand, right? As long as you don't have a super generic name, it makes it easier for you to be searchable through Google Analytics and what have you. So that was the first step, and we dedicated a lot of time there. But the next step was creating leads, right? Bring in leads. Now, those leads initially was through the content we were creating. We were having initially a lot of webinars, weekly educational webinars, and a lot of people would come into our funnel. So we got a CRM, which is one of the most important components of this business that I definitely recommend. I mean, it's impossible to do this business without a CRM. So we got our CRM is HubSpot, and we started adding a lot of people that would come to our webinars to the CRM, that people that came to our website and they saw one of our lead magnets and connected with us. So we built this database of investors that somewhat knew us. Maybe it wasn't a fully hot lead, but it was at least a warm lead that they knew who we were and they had subscribed to us. So there was a process also to nurture these leads. Now that they're in your CRM, they came in to subscribe at some point, but at some point they'll forget about you. So it was important to have an update. So we start sending out a weekly email, and every Sunday at 6 a.m. Pacific time, we send out this email to our database that talks about how where the market is doing, what was our podcast last week, what are we seeing in the market, and gives them a kind of a quick brief view of the real estate market over the last week. So that nurtured those leads. So when we eventually had a deal, we finally eventually put a deal under contract, and I can go over about how we were able to get our first few deals, because it's very difficult for a firm that doesn't have a track record to do a deal. So we ended up partnering with other groups who had a track record. And then now we could then go and leverage those leads, create conversations, and start go through the process of raising capital. But I can touch on institutional as well in a moment if you don't have any questions on this topic yet.
Well, I think that's a great framework, right? And it's absolutely true. It's the same thing, I've lived in my own experience of, you've got to build a brand to create credibility. You have to become a thought leader, right? We both have podcasts for a reason, right? We do speaking events for a reason. Because I think, you've got to, one, be out there, right? And show people who you are and that you're there. Two, you've got to create that credibility. And I think that having what I heard you describe is a lot of these kind of one-to-many relationship type of avenues, right? A podcast where you can speak and thousands of people can hear you. Same thing with a webinar, same thing with your newsletter, right? So I think finding ways to scale to create your credibility, among a wide audience, right? Besides, I think a lot of folks start with as you said, right, you start with your friends and family, and those are a lot of one-on-one conversations, but you can only have so many conversations a day, right? So I love the idea of kind of creating this brand to be able to create credibility at scale, right? And really get yourself out there, and you got to get outside of your comfort zone to do that. It sounds like you've done a great job at building this kind of machine and funnel, right? To then bring people in, nurture them, let them get to know you, like you, trust you, so that when you have a deal, then they're ready to invest, right? Because hopefully at that point they've gotten the kind of vet the operator part out of the way, and it's really about the deal. So that sounds like a really well-defined system. I'm curious, though, what are some of the mistakes, maybe you've made along the way, or that you see other, newer capital raisers, syndicators make, when they're trying to raise capital? Like, where does it go wrong?
I mean, yeah, there's a lot of mistakes that could be made in raising capital. The timing, keep in mind that when we syndicate deals is really and syndicate, just for viewers, listeners might not fully grasp, is, when you are trying to raise capital and do real estate deals, the conventional historic model is really a fund where you structure a fund, you raise the capital you need, and then you go out there and buy the deals you need to buy. And all those deals sit within this basket that is the fund, and investors within the fund have exposure to all the deals. If it's a closed-end fund, at some point you wrap it up and you distribute to investors. If it's an evergreen fund, then investors have redemptions and liquidity at some points there. But a syndication model is project specific. You find one deal, you put it under contract, and then you go to investors to raise capital. It's basically a project-specific fund. In that case, I call it the shotgun approach, where you have really a matter of less than 2 months to raise all the money, if that. In the commercial real estate space, there is 30 days for due diligence, 30 days to close. So it's 60 days for the whole part, but then your legal documents and offering and marketing might not even be ready yet by the time you present a deal to your investors. So you have a short time, possibly 45 days. Commercial real estate deals, if you're trying to do institutional deals, you're talking about at least $20 million and up. On a $20 million deal, if there's a value add component, then you're looking at close to, $7 to $10 million of equity. To go out there and raise $7 to $10 million of equity in 45 days from investors that maybe have never invested before with you, or they've been part of your database, it is a leviathan of a task to achieve. So those conversations are extremely important. The nurture process is extremely important, and to be able to, mistakes that are done is really. The first one was what I described as the chicken or egg, right? Which comes first? Does the deal come first, or does the equity come first? Mm-hmm. So it depends what vehicle you're using. If you're using a fund model, then you could possibly raise the equity and then go look for deals. But it's hard to raise a fund for a newer group who's never had a track record before. What, am I going to give you money on this supposed deal you're going to go and find? At least it makes it a bit easier if you have actually a deal under contract, you physically have photos of the deals, videos, a business plan, then it makes more sense. It makes that process of investing a bit easier. So that's the first hurdle that on the capital raising side that you have to figure out, what is the structure you're using to raise the equity. Second is, just the number of people in your database. I remember when we first started CPI, we heard that somebody had 1,000 people in their database and they were able to raise tens of millions of dollars. I mean, over $100 million this person was able to raise with 1,000 people in the database. But we forgot to so we were happy when we had a couple thousand people in our database, but we didn't realize what he was talking about is that he had 1,000 people in their database that were qualified, accredited investors that they had conversations before that made some kind of a soft commitment. So obviously it's a lot easier to raise money from them than just a random 2,000 people in your database. So you understand what is the lemon you're trying to squeeze, right? If it's just some database you've collected over the years, it might not be the case. The other part is friends and family. In capital raising, personally, like I mentioned earlier, I was a home builder for 10 years. So everybody around my atmosphere knew me as the home builder, right? As somebody who built homes. So when I syndicated the first deal that we had, And I brought this deal. A lot of people were confused because they saw me as somebody who built homes in Vancouver, west coast of Canada. I'm bringing a deal in Orlando, is multifamily, is this limited partnership structure where they're passive investors, and there was component of cross-border taxation where they had to possibly deal with the IRS and file U.S. taxes. So there was just too many negative points there that I didn't have a lot of success raising money. And these were from people who trusted me, that I built multi-million-dollar homes for, that they had, paid me a lot of money to build their home, or they had, carte blanche, allowed me to pick and choose the material and the details of their homes, and that in some cases had sold those homes and made millions of dollars in profit. And it was still hard for me to raise $50,000 from one of these people, let alone to go to people that don't know you. So another, and this is not always the case. Some people have had a great time raising money from their circle of influence, initial circle of influence. But for me personally, it was difficult. So that's another something else to watch out for. Lastly, I'll touch on this, and there's so many mistakes can be made, is on the compliance side. Particularly in our case, we deal with both the Canadian regulators and the U.S. regulators. When we syndicate a deal, we have a U.S., I call it a U.S. master fund, and this is project specific, so it's not your basket of deals I was talking about earlier, but a project specific U.S. master fund and a project specific Canadian feeder fund for that one deal. So the Canadian feeder has his own offering docs, has his own exemption is using on the Canadian side. The U.S. master has his own offering docs, his own exemption is using on the U.S. side. So compliance is another a very important part of it. A lot of people don't realize that we are overseen by the Securities Commission, and that you could easily get in trouble. And we're talking about jail time. This is not just a situation of fine or a slap on the wrist. This is something that people can go in prison. And I think some people in the real estate syndication space have gone, some podcasts I've watched, some people have gone to prison for, committing unscrupulous things and what have you. So, that's other common mistake that people don't realize. What is the exemption they're using to raise capital? Are they within the bounds of legal parameters to raise money and do deals? Can they advertise deals? Cannot. And a lot of Canadians actually watch a lot of videos on YouTube, on social media, and listen to a lot of podcasts, and they hear something that was said about compliance on the U.S. side, and they think the same thing is the case in Canada. But a lot of things are similar in Canada and the U.S., but there's also a big difference in a lot of different factors as well. So those are some common mistakes that comes to mind that I could share in raising money, but I hope that was helpful.
Yeah, I think that was absolutely helpful. I think a lot for people to think about. One that really struck a chord with me was the idea of, you didn't have a ton of success building or raising capital from kind of your immediate circle of influence because they thought of you as a home builder, and I had a similar experience as I started going out to raise capital. I was in management consulting. I had even had my own business in management consulting and had a good amount of success. But again, people didn't view me as a real estate person. They didn't view me as someone they would invest with, right? And so it really was, from going from like the first time I tried to raise money and just didn't, I raised about 50% of my goal. It wasn't successful. To the second time and being very successful. And the difference was really intentionally changing kind of my own personal brand, right? And how people saw me by what I talked about and educating and all the credibility, all those things. So I had a similar experience, and it seemed like it was probably deal 3 that I did, where a lot of, maybe not, you have some diehards, right? Like you said, your mom invested with you. Like my mom also did, and you've got the close family and some close friends, but then it was like those other folks, or maybe were college buddies or things. It seemed like it was probably deal 3 where they started saying, hey, wait, what are you doing? And what are you making? And how much can we get? Right. And those people started coming in like deals 3, 4, 5, I felt like.
Absolutely. That's the same thing with the database as well. We've had people that sat on the database for, and we can see in our CRM in HubSpot how many people have opened the emails, or what are the group of people that open our emails regularly. So they come up to the top of the list. You can kind of, you can look at the list in such ways. So some people sat on the sidelines for a couple of years before making their first investment. So those leads are definitely not dead leads, and the nurture process is very important. But yeah, great point that you touched on as far as the inner circle.
Yeah, I want to switch topics now. And there's a framework that I like that you've talked about before, right? The idea of this multifamily clock. And so I'd love to have you just explain what that means to the audience and we can dive in with some questions.
Yeah, if you zoom out a bit, there is actually a clock when it comes to real estate itself, the real estate market. Real estate is very localized, different markets. Things happen with some market, and it might be on a bull run, and another market might be in a bust cycle. But overall, real estate does go through cycles, and multifamily is very much connected to real estate as well. And it follows the economy, right? Over the overall economy, and we're in particular talking about the U.S. economy. It is worldwide, but let's put this focus on the U.S. economy. So if real estate is cyclical and goes through these cycles of recession, recovery, expansion, and hyper supply, is there a way to not per se time it, but at least realize where we are today, comparing ourselves to this idea of a real estate clock? So what I've talked about in the past is if real estate, or in our case, multifamily, if multifamily cycle was a clock, what time is it really today, right? And looking at that clock, 12 o'clock is top of the market. Basically, the market is in mania. The market is in hyper supply expansion. There's probably cheap debt out there. There's multiple offers. You can see this on the residential side as well. So multifamily is similar to that. Multiple offers, non-refundable deposits day one. A lot of debt out there. People are, there's exuberance. There is mania that's taking place. So that's 12 o'clock. 6 o'clock is the bottom of the market. So 6 o'clock is you're seeing a lot of foreclosures. You're seeing a lot of liquidations. You're seeing a lot of deals coming to the market like we're seeing. We were looking at 2 deals in San Antonio that Blackstone was the lender, and they had foreclosed on the owners, and the price they're asking for those deals is less than the note that Blackstone is holding on those 2 properties. So Blackstone is getting it, taking a haircut. But we underwrote those deals and we couldn't even come up to 80% of asking. So they're going to be losing some money there. So that's your 6 o'clock. Is not only, times are getting tough, interest rates are high, relatively speaking, but you're also seeing liquidations. Because keep in mind, GFC happened in 2008. When banks started failing, Lehman Brothers started failing and what have you. But bottom of the market didn't come till 2011. So it was only till 2011 that you saw the first kind of uptick in the market. So that was the bottom of the market was 2011. So today we've seen bank runs with Silicon Valley Bank and other banks happening, over a year ago. We've seen the economy shrinking. We've seen a lot of multifamily owners getting themselves in trouble. There was this component of extend and pretend or survive till 2025. But now that's, the chickens are coming home to roost. So there is a lot of, so that I would say today, it really feels like 6 o'clock. Is it a little past 6? Is it right before 6? I couldn't say exactly, but I know that it feels a lot more like 6 o'clock than it does 12 o'clock. So as a real estate investor, you need to know that. You need to have that as a plan, particularly when you're syndicating deals. In your initial analysis, you're putting a timeline for the deal. Is it a 5-year timeline, 3-year timeline, 7-year timeline? So knowing where you're at the cycle, it doesn't mean you can't do a deal if you are, anywhere within the cycle. It doesn't make sense sometimes to be pencils down and not do a deal. Sure, it does. But at some ways, it does make sense to do a deal anytime throughout these cycles. As long as you're putting a right debt on the deal, as long as your plan is set. That's a brief kind of overview of the multifamily clock that you asked me about.
Yeah, and so hearing what you're saying, I mean, you think, and in ways I definitely agree with you. We're closer to the bottom than we are the top, right? Maybe we're at 6 o'clock. Based on that, what are opportunities that you see right now?
Yeah, I mean, the opportunities we're seeing, and I really want to touch on this. We were hyper focused. Our market was Florida. We were hyper focused on Tampa Bay. We have a property that we acquired in St. Petersburg, Atlas at Bay Point, and it's doing well. But we got a really great feel of the Tampa market when it came to our analysis and underwriting. When it came to what should be our rent growth, what should be our vacancy, what should be our different factors that we input into our model, right? Our concessions, our expense ratios, and so on. Now we felt that there wasn't a lot of deal flow happening in Tampa, and the reason I say that is because we closed on at Atlas at Bay Point in June of 2024, and it was a 136 unit property that we acquired, and it was really hard to make deals pencil. So I went to our acquisition teams. I went to Paul, our VP of investments, and I asked Paul, "What type of market share do we have in Tampa, Paul? Could you look at the trailing 12 months of June 2024, and could you tell me what is our market share? How many of those deals did we buy, or what percentage of those deals did we acquire?" It's because I want to get a feel of how many deals are happening. So Paul and his team did a research, and we realized in our buy box, which is 100 plus door, less than $50 million, we have a 6% market share. We bought 1 out of every 20 deals that came on the market that matched that parameters. So that's a huge market share for a tiny boutique firm initially started out in Canada, having a market share in Tampa, a city of 3.2 million people. And it was shocking to us. So it told us that there isn't a lot of deals trading. There's some deals coming to the market, but there isn't a lot of deals trading in Tampa. So we started looking at other markets. We did a build to rent project. We partnered with a developer in San Antonio. We're building 30 duplexes in the Helotes market of San Antonio. So we also entered a market for multifamily within San Antonio. But as we were looking at deals, we got so used to underwriting deals in Tampa that initially when we were looking at deals in San Antonio, the deals looked phenomenal. One of the things that we look at is initially when I look at deals and my team is presenting it to me, I look at the 1% rule. And the idea of 1% rule is you look at your average per door price you're buying a deal. Let's say you're buying a deal in Tampa for $150,000 a door, average door price. And you look at your average in-place rents. What is your average in-place rent? And you want to be at that 1% mark, meaning that if you're buying a per door property at $150,000 a door, you want your average monthly rent on that door to be $1,500, 1% of the per door price. So most deals are around there in Tampa, or maybe a bit less. But in San Antonio, the prices were blowing that out of the water. So, looking at deals for $100,000 a door, but the in-place rents were at $1,200. So we're like, great, this is a great market to be in. We got so excited. Well, when we looked at the market a bit more, we realized that San Antonio has a bit of a problem with oversupply, hypersupply. So whenever you have hypersupply in a market, you have issues with occupancy. Your vacancy goes up. So the average vacancy in some of these markets we were looking at was 15%. We're sitting at 85% occupancy, whereas in Tampa, the average occupancy in most markets is sitting at around 90-95%. So we have to adjust our underwriting, understanding that your occupancy is not going to be the same as this other region. So there's a regional factors when you look at different markets for when it comes to underwriting deals and looking at deals. So that's a super. I went down this tangent and I completely forgot the question that you asked. If you don't mind giving me that.
No, it was really just around what are opportunities that you're seeing today based on that idea being at kind of 6 o'clock. I know we're at the bottom.
Exactly. So so when they're looking at San Antonio. With the amount of vacancy that exists, a lot of groups that I was kind of getting to this point, a lot of groups that bought deals in San Antonio underwrote it the way we underwrite deals in Tampa, that your occupancy, it needs to be sitting at around, historically sits at 95%. Your rent growth sits at 3%. But they didn't account for cheap debt coming onto the market, a lot of properties being built in San Antonio. And what happened is vacancy started creeping up. Occupancy started dropping. Rents didn't grow as much anymore. So it started creating a lot of distress, and they had bought those at compressed cap rates. So now, and they had put bad debt. They put bridge debt on deals. Bridge debt is meant to get you from point A to point B. Is not meant to be a regular type of debt that you put on multifamily deals. But people, got used to putting those type of loans on their deals. So now, perfect storm. A lot of deals are in distress. A lot of deals are upside down. Institutions are finally foreclosing on these property owners, and that's an opportunity we're seeing in San Antonio to purchase some of these deals below replacement costs. I'm sure you've heard this many times, but below the note price. I mean, not only with those two Blackstone deals, there's other deals that we're looking at that we're buying these deals below what the mortgage was when these deals were bought just a few years ago. So that's the opportunities we're seeing on multifamily in San Antonio. In Tampa, it's much more competitive because there isn't a lot of deals. You have to try to figure out a way that the deal makes sense for you, right? So a deal, on the standard parameters of underwriting, a deal might not make sense. But is there something? The Atlas at Bay Point deal that we bought, there were these empty storage, empty storage facilities that they had in every building. There's 7 buildings. There was 2 empty building units. This cavity that existed, and they had just left there for equipment and what have you. Every floor had one of these cavities. So our business plan was to go in and turn those rooms into storage facilities for our tenants. So that was something interesting that the brokers hadn't even told us about, that we could have. That these rooms were sitting empty. So you have to be creative in a competitive market to try to find opportunities. But right now I see a huge opportunity in San Antonio when it comes to distressed deals and trying to get in there and buying these things below the note price.
Gotcha. So a couple of takeaways from me. I mean, one, sounds like, and I agree with you, I think we largely are at the bottom. I think we're starting to come up out of the bottom with what I'm seeing up in the Midwest as well, which different markets than you're in. But and then it sounds like San Antonio specifically, one of the markets you're in, it's suffered some hyper supply. And so now you're seeing an opportunity where rents have pulled back, occupancy has pulled back. So maybe there's some buying opportunities right now from groups that came in, they were maybe underwriting inappropriately or overly aggressive. It didn't work out. And so you're seeing some of these opportunities, which I think makes sense at the bottom of the market. Obviously, it's very region and market specific, right? The opportunities in Indianapolis, where I am, look very different than opportunities in San Antonio. And I think the key threat is largely supply, right? Because San Antonio is very oversupplied. Indy, where I'm at, we still need more supply. It's kind of an interesting mix. It's a different market, but key takeaways, it's if you look across markets, it sounds like you can find some specific opportunities, and maybe zoom into San Antonio. It sounds like there could be some opportunities to be picked up in the next year or so as folks try to work their way out of deals, is what I'm hearing.
Yeah, so keep in mind, when it comes particularly to the real estate clock, what constitutes and what has the biggest effect is debt, right? The interest rates. So interest rates, when they drop, it's and usually they drop when the economy is not doing well. So the Fed drops rates to stimulate the economy. Interesting enough that it's a great thing for commercial real estate because the debt comes cheaper and it makes deals pencil and makes helps with the LP economics. But when debt is more expensive, it's harder to make deals pencil because the owners still want to get the price that they believe the property is worth, but because of the high price of debt, the property is not worth as much to the buyer. So what really constitutes the real estate clock is mainly price of debt.
Great. Love that clarification. Thanks for sharing that. And then what's next for you guys now? What's next for CPI Capital? Understanding, we've talked about market and cycle. So do you guys have any projects you're working on right now?
Yeah, I mean, obviously entering the San Antonio market was a big move from CPI coming in there. Now we're in both Texas and Florida. Our second vertical, which is build to rent, we've partnered with a local developer in Texas, and we're building these communities of purpose-built duplexes that we're very excited about. Apollo Oaks is a project that I'm actually going to be in San Antonio next month for our groundbreaking ceremonies for our project there. So excited about that. But I would say it's something I've been working on for 2 years now, and that we have just launched here at CPI is our CPI US multifamily fund, a mutual fund trust structure. So to touch on that, this is more on the equity side of the business, raising capital. Historically, when we chatted with investors, there was a huge interest for investors trying to use their retirement accounts to invest with us. In Canada, they're called registered funds. There are a lot of different financial instruments that Canadians can invest into: RRSPs, RESPs, TFSAs, these different acronyms for different financial instruments they could invest into. Just like the US, Canadians can self-direct their retirement accounts to invest in syndicated deals. In the US, there is a component of a custodian you can use, like the IRA Club, to self-direct your retirement accounts into syndicated deals. In Canada, you could also do the same thing. You can self-direct your retirement accounts to invest in syndicated deals. Canadians hold close to $2 trillion in retirement accounts. So that was a huge component for us, especially when we spoke to a lot of investors. There was a lot of interest. Can I use my registered funds? Can I use my registered funds? And unfortunately, our answer was no, we're only a cash investment. So we've been working for a couple of years to be able to launch this fund. Now, similarly to the US, where Canadians can self-direct, the only caveat, the only difference is that the vehicle that a deal is structured in, it cannot be a corporation or a limited partnership. In Canada, we don't even have any LLC. We don't have limited liability corporations. So the vehicle that investors can self-direct their retirement accounts is a mutual fund trust, which is somewhat of a complicated structure, is very costly to launch, and is very costly and cumbersome to maintain, and for it to be, ongoing management of that entity, because it needs to have 150 investors at all times. There is a component of audited financials that need to be done not only on the entity itself, but any other entity that's involved that's investing to this vehicle. So we've spent the last 2 years to try to demystify this entity and try to finally launch it. So we finally, as of a couple of months ago, we finally launched our CPI US multifamily trust, which is structured in a mutual fund trust. So now we're able to raise capital from investors who are looking to use their retirement accounts and be able to invest into US real estate. So that's been a very exciting journey and exciting part of CPI at this moment.
Great. That sounds like a huge lift. So congrats on that. And August, this has been incredibly insightful. You've given such good advice on launching a private equity firm, how to raise capital, the importance of education, and systems, and building relationships. If our listeners want to learn more about you and CPI Capital, how can they reach you?
I'm very active on LinkedIn. As I mentioned, I'm a LinkedIn top voice. So I'm out there creating a lot of content and a lot of information. So August Biniaz on LinkedIn, send me a message. Say you saw me on Kent Ritter's podcast. I'm happy to provide you with 30-minute call, whatever question you have. If it's something about that you have questions about your journey or your investment journey, happy to provide you with my brain power, as long as you say you saw me on or you heard me on the podcast. Our website, www.cpicapital.com. Check us out there. Our podcast, Real Estate Investing Demystified. But reach out to me. Easy guy to get a hold of.
Perfect. We'll make sure all that's linked in the show notes. And to our listeners, if you enjoyed today's episode, make sure you subscribe on Spotify, Apple, YouTube, wherever you're listening. Share this with somebody who's looking to level up their real estate investing. And I am Kent Ritter, and thanks for listening. And we'll see you next time on Ritter on Real Estate. August, have a great rest of the day, my friend.
Thank you so much. Thanks for having me.